have, the more money is going to be generated from investing. So let's say you have a 10% average return, which is the historical average for the S&P. Then if you have $1,000, you're going to be about $100 a year, maybe a bit less. But let's say you have $1 million, then you have $100,000 of just interest a year, which is pretty much enough to live on an income. So the other one is to counter inflation and secure wealth. So we all know that inflation eats up a little bit in our pie of savings every year. And if we want to beat inflation, we need to do more than just saving. Because if we save, the money that we save today is going to be worth less later. So it's like constantly eating and chipping away at our income. It's negative interest, really. And then it's to have our money work for us. So when we want to stop working, we can have our money do the work for us and just do nothing all day and sip martinis. So what can we invest for? We can invest for retirement. That's probably the biggest investment most people have in mind. You can do a down payment for a house, especially in our housing market, a college fund for your children, and when you finally kick the bucket, you can be the future inheritance. Okay, so the main thing I'm going to be doing today, I'm going to go over the types of investment account. So we have the TFSA, the RRSP, the FHSA, and then we have a few other ones like the RRSP, RRIF, and RDSP. So let's start with the tax-free savings account. This is pretty much the holy grail of the investment account. It's a general account for general investments or saving. Anyone who's over 18 in Canada, or I think it's 19 in BC, depending on the age of majority in your province, can open one. It's a $7,000 contribution limit per year, and that rises each year with inflation. So last year it was $6,500 and now it's $7,000. It's post-tax dollars, so that means that you earn your income, you get taxed, and then after you invest that money. So it's not before you get taxed. So you can't write it off on your taxes like some other of the accounts. But the benefit with that is once you withdraw that money later on, you're not taxed on it. It's 0% tax, and there's no capital gains tax, which is taxes on the money your stocks make. So it's great for getting started. It's pretty much, I think it's an account every Canadian should have, just because it has so many tax benefits, just because you're not paying any capital gains tax, you're not paying any withdrawal penalties, so you can put that money in and take it away anytime, right? There's not many mechanisms stopping you from treating it basically like an extension of your savings account. And yeah, so this is the most general account. If you want to invest in stocks, I would highly recommend this one.
Question.
Yep.
Where do we open these accounts?
So you can open it with a bank account, or you can also open it with a trading broker. So I have a TFSA open with Wealthsimple, which it's a trading broker, but you can also open it with a TD account, an RBC account, really. They can open it and facilitate that for you. So it's pretty easy, and you can just do it online. It takes like 5 minutes. So then we have the RRSP, or the Registered Retirement Savings Plan. So this is really only for retirement. Like the TFSA is saving for anything, but this is purely for retirement savings and investing. So there's a limit on this account. It's much higher than the TFSA. It's 18% of your income, or $31,560, and that goes up every year with inflation. The dollar figure, not the percentage. And it's whichever is lower. So let's say you make $1 million, it's not $180,000. It would be capped at $31,000. So these are pre-tax dollars, and they can be deducted from your taxes. So let's say you make $100,000 a year, and you invest $31,000, or that's 18% of your income, which would be the max. So $18,000, and if you pay $30,000 in taxes, you can deduct, I think, typically it's about 20 to 50% of your contributions. So that can really help. It's pretty much free money. There's a lot of free money in this account once you start working. So let's say, and it also has employer matches a lot. So typically your employer will match, let's say you invest 10% of your income, your employer might say, I'll match $1 for every dollar for the first 5% of your income. And if your employer offers that, I mean, I know all of you are students currently, But once you start getting into the career world, that can definitely be a lot of free money that's just floating around from your employer. It's pre-tax dollars. So these are, before you get taxed, you can send them away and lock them in the RRSP. And then after, they're taxed as income on withdrawal because it works like an investment or a retirement account. So you put the money in now pre-tax, you can deduce some of it on your taxes, and then your employer matches some of it, and once you withdraw it, it's taxed like it's just your normal income. And it can only be withdrawn at retirement or penalties apply. So let's say you want to withdraw your RSP right now, money's short, then you would pay a fee to the government to withdraw that right now. So it's really purely for retirement unless you absolutely need that money right now. Any questions? Then we have the first home savings account. This is actually a really new account. I think it was 2022 or 2021 that it was just and it's an account used to save for a down payment on a house. And it was instilled due to the housing crisis in Canada. It's only for first-time home buyers. And I don't know if many of you have a big real estate portfolio right now, but I'm assuming not. So I would highly recommend this account too. It's an $8,000 limit per year. But the huge thing about this that makes it better than the TFSA, if you're saving for a house, is that it's tax-free withdrawals and it's tax deductible. So if you pay $10,000 in tax, you can deduct up to $8,000 in tax, and when you withdraw it, it's tax-free. So really, money that you're going to pay in taxes anyways, you can take that in and then use it as a down payment. So it's literally free money. There's a $40,000 lifetime limit for contribution, and there's a 15-year limit. So you can't put more than $40,000 lifetime limit, but that doesn't apply for interest. So you can contribute $40,000, but let's say you get 10% interest a year. You can have more in the account, but you just can't contribute more than that. And it must be used to make a down payment on a home, an apartment, or any kind of property. But if you don't use it, the account will turn into an RSP or a registered retirement savings plan after 15 years. So you don't lose that money. It just loses its properties of being that tax-free and withdrawal advantaged account. So,
Question.
Yep.
So with that FHSA, do you want to maximize like the total contribution limit?
Yeah. So the FHSA, you have $8,000 a year, and you have $40,000 lifetime. So the limit resets every year. But since you have 15 years to use it, and there's a $40,000 limit, if you just do the math, you could max it out in 5 years? So you don't need to max it out every year, but I would highly recommend just writing off as much as you can on your taxes for that. And the RRSP, it has that limit is cumulative. So unlike the TFSA where if you don't use it, you lose it, the RRSP, let's say you start making less at the beginning of your career. If you make more later, that limit will carry on every year indefinitely. So you can, let's say you put 10,000 in the first year, you'd have a 20,000, and let's just say the limit is 30,000, just for simplicity. You put 10,000, and you have 20,000 left that you could have contributed. Next year, you would have 50,000 available because it carries on every year and it stacks up, just to make it easier in the early stages of your career where you maybe don't earn as much. Yeah.
You said unlike the TFSA?
Yeah. I believe the TFSA, the money does not carry over per year.
Really?
I could be wrong. Let me just. But anyways, I'm almost certain it doesn't carry over. But I know the FHSA does not. Okay. Finally, we have some other accounts which aren't as advantaged, especially for college students. The Registered Education Savings Plan is for if you're making a college fund for your children. There's some specific advantages for that. The RRIF is just what the RRSP turns into after you turn 71 or you hit retirement age. It's basically when you can start, you turn your RRSP into that account when you want to start taking money out of it. And the RTSP is Registered Retirement, or it's not I just wrote it wrong here, but it's the Registered Disability Savings Plan, and that is for if you have a disability, the government will contribute some money to. So now Eva will come and show you how to pick a stock. So let's give her a hand.
Alright, thank you guys. Now you have an account, and then you know your goal. You know what your goal is. But how, what do you know? How do you know which stock to pick or what company to invest in? Do you have any ideas? Out of all the companies you have, what is some qualities you want to see in a company that you want to invest in? Alright, go
You
first.
make a lot of money.
But how do you know from looking at a company? Oh, what do you mean by making a lot of money?
They have high profit margin,
Okay.
or they have a lot of earnings.
Alright. How about you?
I was gonna say how they were doing in the past, so how consistent.
Alright, so historical. Good. How about you?
If you're young and you don't have a lot of money, you probably want to go with a safer company, so one that shows like pretty consistent, stable growth.
Right, consistency. Anyone else? Or more specifically, oh, I heard a lot of people talking about this company, or it's very popular on TikTok right now, or I see a lot of growth potential in this company. These are all pretty good points. However, today I'm going to focus on one thing, is that you can do some simple calculations to determine whether a company is valuable to invest in. First of all, ratio analysis, that's what we're going to do today. Yes. Who knows what a financial statement is? Okay, what is it? Go through.
It's like a report that shows the performance of the company.
Exactly. It's a quarterly or annually report that shows the growth or over the year how the company did over the year. For the public companies, these are public, this financial statement you can search up online. And there are three parts in these: income statement, balance sheet, and statement of cash flows. I'm gonna show you an example. So how do I get out of this? How do I go to? Yes. Oh.
Oh, also Samuel, I checked, and the TFSA contribution limit does carry forward. So, just press escape.
All right. This is a financial statement for Apple. First thing we have here is the income statement.
Where do you find this?
Oh, just type up Apple financial statement. Oh,
Press back and show me what you searched.
yeah, see? Okay. And, okay, on the first sheet, it will show you the financial performances, the net income, operating expense, and total net sales, just the overall income of the year. Secondly, we have the balance sheet. The balance sheet has the company's assets and liabilities. The liabilities means debts, and assets is what you have. Okay. Thirdly, we have the cash flows. That is how the company used its cash over the year. For example, if you use it in operating expenses or investment, or you build a new building, that will show on the third one here, how you use your money. Okay, with these data, we can now calculate our ratios. There are different types of ratios. For example, price and profitability ratios. The first one we're talking about is price ratios. P to E, price to earnings ratios. This is a ratio that indicates how much investors are willing to pay for $1 of earnings of this company. And a P to E less than 15, usually less than 15, indicate it is undervalued, which means it's traded at a lower price than it should be. And over 15, it is overvalued. good and bad.
Like, how is it undervalued?
Undervalued means that you're paying less for what it's worth, right? For example, I'm paying $15 for $1 of its worth. Compared to I'm paying $20 for $1 of its worth. I wanted to pay lower for more net income. Yes.
Wouldn't it be also, aren't some companies above 15 still good because of
Yeah.
possible future earnings?
Yes. This is one indicator, right? You have to use it with other things to compare.
So just the one indicator is not enough, and it's just an
Yeah.
help.
It's
help
one of the
indicator.
tools to show you that, yeah. It just tells you if it's less than 15, it is not as expensive as if it's over 15. And 15 is also roughly around because it depends from, like, for example, Walmart to a technology company. It depends on the market as well. Yes.
So what is like the average P to E ratio that you would expect for a good company?
Average, well, it says here, but it depends on the actual markets you're looking at.
I can answer that.
Okay.
So the average, it's about 15, but it really depends by industry because there's a lot of companies that might make more than this
Yeah.
because they have very high sales, but also like some other companies that might make less have like a lot more growth potential, or they might have different ways that they value themselves, or so.
Yeah.
it really depends.
Yeah, you see, also compare the price to earning PT ratios to other companies in the same industry. For example, you can compare Coca-Cola to some other food companies and see the difference between them. Next. This is similar, but that one is comparing the price of the company to what it's actually worth. So for example, you want to buy a car at $1,000. That's $10,000 maybe. And the car is actually only worth $8,000. So the P to B ratio would be 10,000 over 8,000. And a P to B below 1 means that it's good, okay? And P to B over 1, no good. Again, you cannot just use this one ratio as an indicator. You have to use it with some other things and overall to evaluate. Then we have profitability ratios. First one, return on equity. This is to measure a company's profitability by showing how much they profit from the shareholders' equity. Do you know what that means?
No. Yes, explain more.
Isn't that what they invest into the business ratio?
Yeah, sure, yeah, exactly. So for example, me and Phil want to open a lemonade stand. And we each put in $100 in the beginning of the year. So that's $200 of equity. And by the end of the year, we made a profit of $50. So our ROE will be $50 over $200. But you don't have to remember this because I'm going to show you a website later on that will tell you all of these
So
statements.
then that would be 25%. Would be your ROE. Yes.
Yes, thank you.
So that would have a pretty good company.
Yeah, and usually if it's over 15%, it means it has a good return. Okay? ROIC. That is similar to the return on equity, but instead of just equity, we're comparing to equity and debts, so the overall capital of the company. Yes? Moving on. Dividend yield. This is very important for people who are looking for income investing. So you're waiting for a dividend paid to you. You want to see how much dividend income per share related to the current share price. And if it's growing, that means it's good. And also compared to the other companies or its historical data.
What is a dividend?
Dividend, what did we go for it? What did we get? Okay, what is a dividend? A dividend is
It's like an amount of money that the company pays out.
paid to the shareholders. Yes. So a company makes a certain amount of money, and they'll pay dividends first to their shareholders. And then some will go to the operating expenses, some will go to investment, and some will go to dividends, which is paid back to the shareholders. Yeah? And it varies between different companies. There's not a set value of.
Is that free money?
That's
No,
that's
it's
not
not
free.
free money.
You invest in money, right? It's not they're giving back to you maybe every quarter, maybe every year.
Maybe I should explain a little bit
Sure.
more on that. So not every company pays dividends. A lot of companies don't because they're still growing. Dividends are typically reserved for like much more established older companies because they might think that they don't have any more opportunities to grow. So instead of putting the money in the share price, it's coming out of the share price and they're paying out the investors instead. So let's say Home Depot is like let's say it's very established and it doesn't think it can grow much more in its market. It might use some of its profits to pay out investors instead of reinvesting it into the company. So really, dividends, they're coming from somewhere. It's not free money, but it's a different way. It kind of gives you more control over what you do with that money. You can reinvest it in the company, but you can also use it as income. So that's why it's popular for retirement funds because it's paid out like cash. So yeah.
Yes.
Is dividend what the company gives you minus what you invest, or is it just what the company gives you?
It's what the company gives you. You don't take your investment back. They'll pay you a certain amount of dividend. Yeah.
Why would Home Depot in this case choose to pay dividends rather than buy back stocks?
Pardon?
Why would Home Depot in this case choose to pay dividends rather than buy back
Yeah,
stocks?
they can do both at the same time. So when I say get an income, right, after their profit, they'll put some into investment, some into paying dividend, some into like making a new building, things like that, or technology development. There's a couple investments they can do. Does that answer your question? They do.
Yeah, I mean, like, it's just like an infinite liability that they have.
It's like an incentive, right? Say I have a company and you want to invest in my company for what? Like my company might not be that great, or my company may be great. If you invest in me, every quarter I will give you 5% of your earnings. Does that encourage you to invest in my company?
Well, if you're giving me 5% of
I
your
guess,
capital,
but it
that's
seems like it's a bad deal for the company or a bad deal for the investors, right?
So really, it's kind of like it's good for both of them, right? Because the investor gains a bit of cash, right? Dividend per term, per quarter from the company, and the company earns you as an investor. Does that answer your question?
Yeah, exactly.
Yeah.
And
Sorry.
yeah, not all companies will choose to pay dividends, but the ones that do, like it's like different demographics. Like people who are more focused on growth might invest in like younger companies that reinvest that money into their shares. But for another demographic, dividends might be a more attractive option if you're trying to live off the income from your investment, which might be more consistent. But it really depends.
Okay. What were you gonna say?
Aren't high yield dividends mainly for retired people? Like, shouldn't we mainly be investing in growth stocks?
Well, it depends where your goal is, right? If you're expecting consistent dividend coming back to you, it's an option. Yeah, that you don't have to look at that. It's just an indicator.
It is typically more for retirement.
Yeah.
But it's something to keep in mind. I mean, some people like them more, but typically you want dividends mainly for like when you need a sustainable
Yeah.
kind of stream of income.
I guess what I'm not looking at is if the company is.
Yeah, you don't have to look at that.
Isn't like focused on growth and building, because it's lacking. Why do they want investors in the first place? Because there aren't investors who are here trying to grow.
Yeah, so just getting where you're at with you, you're kind of wondering why the company pays dividends, right? Like, what's the point when they can just reinvest it in themselves? Right, so like the whole point of having it is sort of in a way, I'm encouraging other people to invest in me. So if, say I sell cars, and Phil sell cars, if I pay you a dividend, that might mean that I have less money to spend on my company. However, in the long run, I have more people like you putting their investment in me, right? So it's really about like, their own decision and how they choose to handle their investments.
And again, dividends, like a lot of people think that they're not like. There's definitely a debate out there on whether companies should just reinvest into their company or pay out dividends. But anyways, I think we're spending a lot of time on this.
That's okay. Yeah, that's not like essential for you to look at. It's just an indicator for if you want to have a sustainable dividend paid over time. Okay. And finally, the last one we're going to talk about today is the market cap growth. What is a market cap, Phil?
Market cap.
Okay, Greg, go.
It's like the total value of the company.
Total value of the company? Market value, yes, okay. Phil, what are you going to say?
Yeah, I was gonna say the same thing.
Okay, great. And the market cap growth is the change in between each years of the market cap. Okay, and we want it to be consistent and increasing would be better. Yes.
So what does outstanding mean? Company's outstanding shares?
Oh, it's total shares. And now I'm going to show you. So for example, pick a company. Tesla? Yes?
Isn't the stock market closed?
I'm not trading right now. Alright, if you go to financials, look. Oh. Okay. Ratios. Tells you everything. Example, current P/E ratio 43.92. What does that tell us? Bad. Why? Why bad?
I guess it's a growth stock, but right now it's kind of.
If we're only looking at, yeah, okay, yeah, it depends on the. It means that it's very expensive right now. Okay, it doesn't actually mean it's bad, but looking at a company.
So what does a negative PB value mean?
Negative B?
Like the P ratio is like for 2019 was negative.
Yeah.
Oh, here?
No, the P ratio.
When it's negative?
Yeah.
I actually don't know.
It's because they're not positive.
It's because they weren't earning money at the time. So they were losing money.
Which company is this?
Tesla.
Okay, yeah.
Yeah, they weren't earning money. That's yeah. You have everything you want here. You can compare with other companies or with the historical values. Any questions? All good? Okay. Welcome, Daniel.
Just want to thank you guys for sticking with us so far. So as you can see, this is very complex, right? All these numbers, EV, EBITDA, anyone know what EBITDA means? Yeah, that's a fun one. What does it mean?
EBITDA is the earnings before interest, tax, depreciation, and
What was the last one?
amortization.
Yeah, but it's okay. Like, don't worry about the numbers too much or the words, right? Because there's so many. Like, if I'm going to scroll down on this list, let's take a look. This is just a partial list, yeah, but it's very long. There's many things to cover. So it's that's why with stocks, there's no one single person that knows everything. So sometimes if you ask me, what does, say, debt to FCF ratio mean? I have no idea. I'm just gonna throw it out and be honest here. However, all of us, we're starting out in this, right? We want to learn how can we make our money multiply? How can we invest? Yeah?
If you click on it, it tells you.
Oh, it does?
Yeah, you put
Oh,
it.
that's wonderful.
There you go.
There you go. It stands for, it measures your debt levels relative to a company's free cash flow. And what does that mean? I still have no idea, but I will soon.
Daniel, if the ratio is high, it means that the company will need to spend a lot of.
I appreciate that. I appreciate that, Phil. All right, so all of you follow our Instagram, right? So our Instagram, I have linked or Linktree. I'm just gonna open this up. Linktree. I got it.
You know you can just use the mouse,
Yeah, your track record's a bit different.
right?
Right. to our website right here, University of Waterloo Stock Club. And here you'll find some information. We have our presentation from last week. If you want, you can take your time to take a look at it. However, most of these are just like words. Yeah, so it's important if you come, we'll talk more about it, right? Like here, I talked about why he's not wearing clothes, but maybe we'll talk about it next time. So you have some links there. And so once again, since we're all very new to this, we don't know what a stock is, we don't know what investing is, we don't know what EBITDA means, right? But that's okay, because I've actually created a very simple little layout for you. Do you have Lucid, Phil?
No, I don't.
Yeah, I'm signing you up right now.
Yeah, right. Just sign and I'll disconnect it.
Okay, never mind, that's fine. I've also included a PDF, just in case you guys don't want to sign in. So, just from the outside, this looks very complicated, right? It looks almost like something you would see in science, but thankfully, this is not science. It is only a slightly bit harder. It is finance and investing. But don't worry, this chart is very simple for you. So first, what did this say? Start here. So that means you're going to start here at this step. Right, let's talk about the economic moat. Have you heard of the word moat before? Moat? Yeah. What's your name? Yeah. Alcio? Alcio? I got it. Anyway, can you tell me what a moat is?
I think it's a bridge that like blocks out something.
Yeah, something like that, right? So back in the medieval times, when people had castles, they were worried about people invading their castles. So they had a moat, like a little river around the castle. And that little river protects their castle from being invaded, right? By like barbarians or such and such. So companies also have a moat, right? And what protects this company from their competition? What separates the company from others? So from this diagram, it shows that all of this goes into a company's moat. If you're a bit stressed out right now because of all the lines, it's okay. It'll be very simple once I'm done. So we think about what advantages and disadvantages the company have, right? But how do you do that? Well, let me tell you right here. How well is the company managed? There's a typo there. It'll be fixed. I assure you of that. Who manages the company? Right, that's one thing you want to look at. You want to look at how strong is their brand, how established is their brand, does the company have any regulatory policy? Right, if you don't understand what any of these mean, feel free to ask or don't like back question. You can ask me anything. Like if you ask me what 2 + 5 is, I will tell you that the answer is 6.
I was about to ask that, but you just answered it.
I got you. Right, so let's take an example. Let's say we want to learn about the company brand. No, that's not good. We want to learn about the company management. Right, how well is the company managed? So if I want to take a look at the company, give me a company, Phil.
Tesla.
We just did Tesla.
Okay.
We want to look at the company Orange, right? So the company Orange, how do I know if it's well managed? Well, first off, I can do some research on Google before diving into the numbers. Right, I'm gonna follow this line. Okay, who was their CEO? How was their track record? Say their CEO was a convict who just got out of prison for dealing coke. Chances are
He's good at business.
he might be a great business guy, or he just got lucky, right? Right? Or they had no experience and their dad's multi-billionaire and they just put him on the board and manage the company. Signs are maybe we don't want to invest there. But this is not financial advice, so please do not sue me. Who is on the board of this company? We can find out with a simple Google search. I will demonstrate. Who is on the board of Apple? And then we click enter, and there you go. Your current board members are A, B, C, and D. That doesn't really matter. Oh, it worked.
Family.com.
What was that?
Our result is from family.com.
It's apple.fandom.com. Okay, what about Apple leadership? Apple.com. That more trustworthy for you? Much better. Okay, perfect.
Where's Steve Jobs?
Steve Jobs.
Yeah.
All right. There we go. So we did some little research. This chart is still being created and updated constantly. And if you guys want to work on the chart as well, feel free to let me know. So now let's look at numbers, right? What can numbers tell us? Because in the end, you find that the best indicator for anything is just numbers, right? Our grades are numbers, other things are numbers, 5 is a number. So let's see. Earnings growth, all right? I'm gonna follow that line into another line. It's also titled earnings growth. And then I'm gonna follow that line all the way here. And would you look at that? Earnings growth is under the category of financial metrics, right? Financial metrics are what Eva mentioned. They're like ratios, they're numbers that tell you how companies performing. So how is earnings growth calculated? If you guys are curious, this is how, right? It is the current earning minus the previous earnings minus divided by the previous earnings. So it just shows you a percentage growth. So say if today my earnings were $110, and yesterday my earnings were $100. So the difference between today and yesterday was $10. And all that divided by yesterday from $100 is that I grew 10% in earnings. That makes sense, right? Yesterday I earned 100, today I earned 110. Using the formula, I got 10% increase. So it's very simple to look at. And what does earnings growth tell you really? It just tells you the increase in the company's profit over a specific period, right? Which is shown by the formula down below. And well, there's more lines. Okay, let's look at orange. Now here's more information about earnings growth. Did you know that earnings growth reflects the company's ability to increase its profitability, often leading to higher stock value? I knew that because I made this chart. But if you didn't know it, now you do, right? Very simple. And you have any questions about earnings growth? No, that's wonderful. That means you guys all understand what earnings growth is. I assume. Now, let's do another example. Say, I want to look at the economic mode before I start investing into a company. I want to look at, all right, let's see. How is our financial health? So financial health actually differs from personal health because we don't look at company organs, blood levels, and nutrients and such and such. What we actually do look at are financial metrics, if you guys remember what that is. So, Adam, what is a financial metric? Can you give me an example?
Ruler.
An
Yes.
example is a quick ratio.
Yes, that's perfect. A quick ratio. So a ratio, that's very fast. I know what a quick ratio is, but it is definitely one of the financial metrics. So how is their health, right? How healthy is this company, or whether I should invest in it? You want to kind of look at the different financial metrics, right? Say earnings growth, where do you look on that? Why don't we take a look at return on equity? So in return on equity, follow the line, oh, right there. Return on equity. Now, how is return on equity calculated? It's calculated with the net income, so the total income that the company made, divided by the shareholders' equity. So how much money is invested into this company? And this is going to be a percentage, right? Which is why times by 100. And so what does this do? It measures the company's profitability, right? It shows you how much profit you get from every dollar you invest into the company. Yeah? All right. And so this is an indicator, right? Indicator, English is my second language, so an indicator is something that indicates something, right? So it shows how effectively a company uses their investment to generate earnings, right? If I have a return on equity of 100%, that means for every dollar you put in, you get a dollar, you get 100%, one is one. So let's do a little activity. What if I invested $10 into stock A and the return on equity is 50%? How much money do I get back? Yeah, I think so. I said $10, right? Yeah, so 50% of $10 is 5. And so typically a higher return on investment means that the company is financially healthier, but that doesn't necessarily mean it's true. Right? If I have, say, a company that's completely fake, it doesn't exist. But it does exist, but on only like for you guys. But at the back, I'm money laundering. Right? I might have a really high return on equity. I might be making a lot of money for you guys. but that doesn't mean the company is going to be good in the future, because the company just might crash and go down. So that's what one of the metrics tell you. And so this chart has plenty of metrics for you to look through on your own. Right? You got your price to book, you got your price to earnings. As long as you follow the line, you will see the respective categories such as their formula as well as their description. So now let's take the time to do it for real this time. So let's take a look at Yahoo Finance. On this site.
Just search it. I'm not writing
Sure, yeah. So, just looking here, I'm going to do one more example with an actual example here. So, all right, I want to look at the earnings growth, right? I'm going to follow earnings growth, okay, right there. And now let's take a look at the number for earnings growth. So let's say I want to look into the company Amazon. Yeah, Yahoo Finance. Now look at that. Look at all of these numbers. The truth is, you're not going to use all these numbers. If you do, it's going to take you plenty of time. You can read through this list, take all the time you need. Right? But Yahoo Finance is a free tool. It doesn't cost you any money except for the ads that you watch. So really, it costs a bit.
I have an ad blocker, so.
Or you can install an ad blocker. So if you take a look at down here, it kind of tells you the market cap. You guys remember we covered that about 2 minutes ago? Market cap. It shows you earnings, right? It shows you volume. Also shows you the current price, which we'll talk about later next week. So if you want to look at more information, you can go into statistics. Yeah.
If you go back to the previous page,
Summary.
yes, it says that earnings data is from April 25th, 2024 to April 29th, 2024. Why those numbers specifically they haven't happened?
For the future.
Yes.
So right now, I believe the earnings date right here is their expected earnings, right? Is it? What is it?
First quarter.
Yeah.
That's the date it'll post it for the first quarter.
Right. That's
Oh,
the
yeah,
date
it's
you'll
when
post it for the first quarter.
comes out for Q1.
There. So here's an example of they know, I wasn't too sure. So it's going to happen quite a bit. However, you look on stats, you can find everything that you need. It's a long list, but let's say we're looking for growth, right? Growth is going to be, got your gross profit, your total growth, TH. It's hard to do. But I'll show you way two.
Your content.
Amazon. Let's say we want to look at quarterly. There we go. There is another stats that you can find right here. So net sales revenue, so that's their growth. So the thing is, you can't find something on Yahoo Finance. You just search it up on Google, and you want to use a reliable page. You don't want to use Reddit because most of the time Reddit is unreliable. All right. So who wants to see us buy a stock right now? Which stock should we buy? Let's have a little group discussion. Yeah,
With my money.
Starbucks. What should we buy?
Shopify.
Shopify.
Or Costco.
Or Costco? Okay. Should we buy one Bitcoin? Yeah? Which one?
Where's the money coming from?
That's good. That's good. Let's take a look at it. Yeah? What's up? Alright.
Juicero. That's crazy.
Yeah, also, who wants to know more about crypto? I'm just curious. Nobody wants to know about crypto?
I would love to.
Okay, great.
Let's figure out stuff.
Well, I'll go more into the future. What's that?
Bitcoin.
Bitcoin? Yeah, I think we should talk about Bitcoin.
I just okay. So this is my account, and I'm gonna be spending my money. Okay, so we will see. So here, this is my wealth symbol.
4.
What?
Why if you close the 4?
Huh?
How are you attaching?
What?
The stock market closed already.
Yeah, I know, but we could just put in like an order now, and then after it's gonna execute tomorrow.
Why is it closed?
The market's closed right now. The market's closed right now, but we can put an order in now, and it'll get executed tomorrow, so it doesn't even matter. Yeah.
How do you do the after hours trading?
What?
The after hours trading, how do you do that?
How?
So how?
I have no idea.
How do you like trade after hours? After
Yeah?
hours.
What? Yeah, that's what I'm gonna do. I think I'm gonna do Athabasca because I'm betting for Pierre Poilievre to take Trudeau out of office and then after remove the carbon tax. So I put like $20 in my account. So how many shares should we buy? $4.31, right?
Buy
Max.
900.
We'll buy
Just load it up.
max. Where's the max?
He's gonna cancel.
I think I can buy like 4. And you click this. Are you gonna show my card information? I'm going to do a quick check. Okay, it does not show my card information. Because I'm buying stocks for myself, not all of you. And that would be unfortunate. Okay, so then after, this is literally how easy it is. So we can even do some analysis. We can see some market details here. Like we have the P&E ratio, the bid to ask, last sale, and see it says market close right now because the market closes at 4 every day. But we can click buy now, and then after, like it's a market order, so that means that it's just gonna buy the amount of shares at whatever price it is. So basically, it's if Athabasca goes to like $200 tomorrow, it would purchase for $200. But obviously, I only have $20. So it will be submitted when markets reopen, and then after, you can also do some other orders like limit. So you set a price that the top price you're willing to pay, and then it will execute as soon as the share price dips below that. Or you, on some brokerages, you could do fractional buys, which is like, yeah.
If you make any profits, would you split it with us?
Actually, if you guys want to make guaranteed profit right now, there's a code you can use on Wealthsimple.
He's gonna earn money off
It's
of
my
you.
MLM.
I don't need to sell from.
He's gonna earn money off of you.
It's a referral code, and we will use that money to buy pizza for everyone at Stocks Club.
I use people.
What?
I use people.
You use Vivo? Yeah, you can use anything, honestly, but it's just I like Wealthsimple for starting up, just because it's so easy and the interface is really good. The fees are kind of meh, but just yeah, it's all right. Okay, so I'm now betting on Justin Trudeau's grave by buying this because if Pierre Poilievre gets elected, see if we look here in the financial note, you can see we have any regulatory protections, and since we're buying an oil company, then oil has like some of the highest regulatory protections ever. I mean, we all know about the carbon tax. We all know about a bunch of other taxes, taxing everything possible on oil in Canada. But if different political parties get elected, if the Conservatives get elected, per se, one of their big policy goals is to reduce the carbon tax. So then that would probably kick the share price up because there's less regulation. So we will click confirm order, and it's literally that easy. Thank you and then see, you can see market buy February 1. It's, yeah.
So, okay, so after you bought your shares, let's say like you get, like, did it
Sure.
just, what happens if you're sure, I don't
Okay,
know.
I can actually show you in my portfolio right now. So in my TFSA, let's say I already have some shares of Athabasca. Once you have them, let's say I executed my purchase here. So you'll always own a specific amount of shares unless there's stocks redistribution or like split or something. But unless you sell or buy, but the price of that one share will go up and down So if we go in our past presentation, we actually did the pizza analogy. I'm sure you filmed this one. So let's say you bought it at $1. You still have that one slice, but if the whole pizza gets worth more, then your slice gets worth more. So let's see. Let me go hit my wolf's book. So I bought. I have 20 shares of Athabasca, I believe, and if nah, just trust. And I'm up like 5% on this. So, anyways,
I encourage you to buy penny stocks.
this is not a penny stock. It's like it is not a penny stock. What's the market cap? 2.54 billion. You call that a penny stock? All right, whatever. So, basically, since I bought it at like $3.79, I have 20 shares, right? But then you just multiply that amount, and so yeah, you can either earn money or lose money. Like if I own 100 shares and it goes to zero, then I'm gonna own 100 times zero. Does that answer your question? Or? Okay. So yeah, and see, I think I actually.
Wait, what happens if you buy stocks? Because I know Apple at one point they have to split.
Yeah.
Right?
Mhm.
So if you had bought shares before after the
Yeah.
split, then what happens after?
Did you get more shares?
Yeah, you just basically, because think about it this way. So let's go back to our handful pizza chart. So let's say you own one share of Apple valued at $10, and Apple says, okay, our shares are starting to be worth a little too much. We want each individual share to be more accessible. So they cut the pizza. You would have the same slice of pizza just cut in half, right?
This is
So-
the ratio.
so
maybe
it's
like 1 to
basically-
2 means that
Yeah,
right
we don't
now
have a marker, but do we have a marker over there?
well, 8, right? Oh, 1 to 2, about 60 now. That's the total.
So it's like cutting a $10 bill in half. It's still $10. It's just two halves of $10. It wouldn't be worth anything, but do you get what I mean? Like the value stays the same. It's just the number of share increases because if you look at the whole pizza, that's the market cap. The market cap, the worth of the company stays the same. It's just there are more shares to go around.
Okay.
Same thing with like printing more money. Okay. So, yeah, and then after the market cap with the P&E ratio there, it will get executed probably tomorrow at around like 9:30, 9:40 when market opens, depending on the volume, which we can see right here. So yeah, and then after it, you can see where did I see activity? Yeah, I just actually got paid a dividend of 83 cents.
Wow.
Thank you. And I also had the joy of paying 12 cents in non-resident tax for the US because I own US stocks. So that's another joy. But Wealthsimple actually just does it for you. Like there's a tax section which I have never touched, but it's really easy to file your stuff there. But yeah, so you can buy shares. You can also buy crypto if you're feeling bullish, if you're feeling gambling, or you could just go to the casino. It's pretty much the same thing. Yeah. So yeah, that was yeah,
Have you ever made money off of crypto?
absolutely.
How much did you make exactly? Can you
Yeah,
like, show us
it's
your
2
stats?
cents.
Pardon?
Can you show us your stats for crypto? Like what
Stats
percentage
for
did you get?
crypto? Well, I'm still waiting for this to unstake, but I closed my position at 44% in a month and a half or something.
Yeah.
Like, so basically, I had like $300 just to throw away in crypto. I put it in a bunch of different stuff and it went up 40%, and now I sold it. And now it's crashed like 35%. So I'm glad I got out.
Yeah, I just want to make sure for everybody here, do we all know what the difference between investing and trading is?
I'm sorry,
Investing versus trading. What's the difference? Yeah, so
Trading is like, I could be wrong, but investing is like, you give something today and you get something more tomorrow. But trading is like an exchange, so I give you something and you give me something and they both are the same.
Yeah, what you're saying?
It's like investing is more like a long-term perspective, while trading is like a shorter perspective, like day trading.
Yeah, exactly. Like we talked about that in our last presentation. If you guys want, feel free to look through this. There might be like a bit things to explain. Like this part, we're talking about why is it like this and not like this, right? The different factors that affect the stock, right? Risk return, and so over here, I just want to bring your attention here, is a risk to return chart, right? The higher the risk on this side, the higher the risk. Right, as you can see, cryptocurrency is pretty high risk, but it's pretty high reward, right? And so that kind of brings us to the end here. Oh. We want to know about, like, what do you guys want to know, right? So things for next week we're going to cover are, what are we going to cover next week?
We have the weekly time. You want to show?
Yeah, sure. Let's take the Notion one. So while we're filling that, so what do you guys want to know? Is there anything? Yes.
What is a stock?
What's a stock? Well, you know, we actually did cover that last week.
Sorry.
But it's okay, we'll
That's
cover
okay,
it
we can
again
go over it.
next week. So we write that down here, stock. Yes.
What's a good database that you guys would suggest, like Bloomberg or Yahoo Finance?
So Yahoo Finance is pretty good. They have pretty much everything you need. And if you're into coding at all, you can also use Yahoo Finance for their code finance. However, Bloomberg is very good. In fact, it's excellent. But it costs about $50 a month, so I'm not too sure if we have the budget for that. However, Royal does have a Bloomberg terminal that's free for everybody to use. If you guys are interested about that, I can do a quick demonstration. Cool, yeah. Anything else that we, yes?
Like, for someone who's just starting off, how much money would you say is good to like start with? Like that.
No, 500.
The higher the risk, the higher
I would say
$500.
honestly, like,
You're 5 to 1. You're 500.
like it. Honestly, how much money you need to invest? It really depends on how much you have.
I want to say how much you are.
How much you're willing to lose.
Really good.
Like there's a pretty low chance that you would lose everything if you put, depending on what you put in. But like, don't use, as long as you don't use money that you need or
Yeah.
that you would feel like you can.
Yeah, so what I would say is I would invest money that you're willing to invest. 'Cause chances are you're not going to lose 100% of that money. But what's really important is how much confident you feel. Right? The more confident you feel, the more money you're able to put in. So right now, if you're only comfortable with $100, then I would not do 200. Right? You gotta like learn, you gotta like read books, watch video, and until you get more comfortable to a stage where you're willing to put $1,000, or even $2,000, or even higher.
Yeah.
Yeah.
Just, yeah, like I would say anything to start is just better than nothing because then you can start to build confidence and then once you learn more about stocks and stuff like that. But if really, if you're putting it into like an index fund like the S&P 500 or mutual fund ETF, then it's really, like that's a very easy way to get started, I would say. But yeah, just
Cool, yeah. Anything else? So are you interested in learning about like trading, how that works? We just like to see a bit of that.
the candle charts.
Like candlesticks, right? See how you can make $10 in a minute. It's been done.
It's been
Yeah?
So like when you, like how, you know how the stock market goes up, right?
Yeah.
So that means the average person who invests in the stock market is making money.
Yeah.
Where's the
Pretty
money
much.
from?
Okay. Actually, wait, do you have a marker?
What is money?
Okay.
Okay.
Where's the money coming from?
Yeah.
Okay. What?
So you're shareholder now, right?
I'll show you briefly, but we'll cover it in the next meeting, okay? So,
Also, if you guys have to go, you can go. We don't want like, we don't have to feel bad for leaving. You know? Like, we don't feel bad.
Yeah, thank you guys for coming.
Why was that feed a different thing then?
Okay, this is the PPF. This is what PPF taught me.
No, I
Okay.
heard it only the second time.
so for the stock market, when you put money in, really, all of investing is all about saving money now so that you can make more returns later.
Okay,
So let's say
it just
you're
happens.
to do.
It's just
Well, hey, if you guys want to stay back and chat a bit, like, feel free. We're here for
happy
a while.
That's
But yeah.
The wire is closed.
Okay, so let's say I have ovens and pizza, right? So if I want, right now, this is the most I can produce of either one without any point on this line. Let's say 10 ovens here, 0, and then 0, and then let's say